Nike has the third highest value rating in Rateday's database today. All that means is that based on Nike's quality and based on Nike's free cash flow multiple or the expensiveness of the stock, Nike is one of the timeliest buys you can make in the market today. As you can see, the value rating for Nike is currently an 87. Anything above an 80 is considered a timely buy. So as of right now, Nike is well within that zone. The reason for that is not so much Nike's quality. The quality hasn't changed all that much. As a matter of fact, one could easily argue that the quality of Nike's business is going down over time. The fact that the value rating is that high is mostly due to the other side of the equation, namely the stock price. The stock price hit a high of $177 in November of 2021. And since then, the company has dropped and dropped and dropped for a total of 67% in 4 years. If we zoom back to the entire history since 1985, it's clear that this drop, this current drawdown, is the largest drawdown that Nike has ever experienced since going public. Clearly, there's something wrong with Nike. That's what the market is signaling. I love this chart because it's just a great example of how quickly the sentiment around a stock can change. If you look at what people were saying about Nike in 2020 and 21, it's like this company was walking on water. Nothing could go wrong. This company was just printing money. Today, just 3.5 years later, and it's the complete opposite. It's almost like nothing can go right for Nike. And this is a very popular stock. It's a very popular company in general. Lots of consumers know it. And so there's a lot of chatter about this in the investment community. You have people that hate it, and you also have people that love it. One of those people is a very famous investor called Bill Ackman. He runs his own fund. Through his fund, Pershing Square Capital, Bill Ackman currently owns 18 million shares of Nike. His position is worth around 1.4 billion. So the man is making a huge bet on Nike. It's currently 11% of his portfolio. And if we zoom in on the transaction history for Bill Ackman's fund, we can see that his Nike position is very recent. So he's been buying the dip. He started the position in Q2 of 2024. He really added to the position in Q3 of 2024. And then he was still topping it off in Q4 of 2024. So his average price is probably close to $70 to $80 per share. Is he right? Is he seeing that other investors are not seeing, that the market is not seeing, or is he wrong? That's what we're going to be talking about in this video. In the first section, we're going to be talking about everything that's going wrong for Nike, all of the risks of investing in this company at the moment. In the second section, we'll be talking about things that are going right, or potential silver linings for the company going forward. And finally, in section 3, we'll be going through a valuation to see what kind of price would be a fair price to pay for Nike shares. So why is Nike stock so hated, and why is Nike stocks down so bad? Well, the first reason and the main reason is competition. For a long time, Nike was the king of trainers, and Adidas was a close second. What happened at Nike was a series of missteps following the 2020 COVID pandemic. Nike overestimated its brand power. They thought that consumers would prefer to come directly to them, directly to their own internet website, and do business directly with Nike. And Nike banked on that. Nike pulled out of many third-party retailers like Foot Locker. Now, this was a move that would have paid off really well if consumers had actually gone to Nike. But that did not happen. Consumers still opted in to go to third-party retailers in order to browse what shoes are available, let me try them on, which ones feel nice. And that Nike had not anticipated. When Nike pulled out of all these retailers, it left a lot of space, a lot of open shelf space. And that open, free shelf space was filled up by new competitors like On and Hoka. If you live in a big city, you've probably seen these shoes everywhere. They've really taken over. People think they look good. People think that they're comfortable. At the end of the day, trainers like these are fashion items. And so when a brand like On or Hoka comes up, it's new, it's trendy. People want to buy those, not the old and boring Nike. Let's do just a comparison of the latest quarter for Nike and On. Nike's revenues were down 9% in total for the quarter. On the other hand, for On, revenues were up 35% in the previous quarter. So I don't need to draw a picture for you. It's pretty clear from the statistics what is happening here. The second reason why Nike is in a lot of trouble right now is none other than Trump's tariffs. Last week, Trump imposed a series of reciprocal tariffs on all the countries in the world, pretty much. But some of the countries that were the most affected just happen to be the countries where Nike has all of its manufacturing capacity. We've got China, 34% tariff, Vietnam, 46% tariff, and Indonesia, 32% tariff. These are the countries where Nike has 95% of its manufacturing capacity. So, whenever Nike's shoes are sent from its manufacturing sites in these countries to the US, there will now be an extra 30 to 50% tax on top of that. Something to keep in mind here is that Nike only derives about 40% of its revenues from the US. The other 60% is global. And so these tariffs will not impact the majority of Nike's revenues. That being said, it's still going to be a big chunk of it. So what's going to happen here? Nike is going to pay a big import tax. The company's probably going to pass that on to the third-party retailers, which are probably going to pass that on to the consumer. So the most likely outcome is that Nike shoes are going to become a lot more expensive for consumers in the United States. That being said, demand for Nike shoes is not that inelastic. If Nike shoes become 20 to 30% more expensive from one day to the next, a lot of people are just not going to buy. So the consequence of these two things is that Nike probably isn't as cheap as it looks. Right now, the company trades for a free cash flow multiple of 15, according to 2024 free cash flow. The reality is that 2024 was a really good year for free cash flow, and it's probably not gonna stay this good. Already at the start of the year, the company was expecting a 10% drop in revenues. So far this year, in Nike's fiscal years, 3 quarters have passed, and we've seen a 9% drop in revenues and a much more significant drop in earnings per share. If we add tariffs to that, it's very probable that Nike's free cash flow will go from 5.8 billion in 2024 to roughly 2 or 3 billion in 2025. Within all of this doom and gloom, Nike still does have one or two things going for it. Nike is just on a different scale to On and Hoka. Let's look at revenues, for instance. Going back to the latest earnings release, we can see that Nike generated $11 billion in sales in 3 months. In the same time period, On Running generated 606 million Swiss francs in sales, which is around 700 to 800 US dollars. So it's simple. Despite Nike sales leveling off or decreasing slowly, and On sales going through the roof, Nike still makes 16 times more in sales than On Running. This is the last yearly update for Nike on Rated A. In that update, I wrote, history shows that competing against Nike, a firm whose advertising budget is larger than Hoka and On Running's revenues combined, is really hard to do over the long term. So Nike spends on advertising every year as much as Hoka and On make in total revenues for the year. That difference in scale is non-negligible. Nike is clearly going to be around for a very long time. For companies like On and Hoka to catch up to Nike, it's going to take years and years of compounding sales. The second point is regarding tariffs. Yes, Nike is going to be hit extremely hard by Trump's tariffs, but actually, On Running and Hoka might be hit even harder. The same way Nike has its manufacturing supply chain mostly in Vietnam, On has its manufacturing capacity in Vietnam and Indonesia. Hoka has its capacity in China, and Adidas manufactures in Vietnam and China. So all of these companies are manufacturing all in the same place. And if we look at the percentage of sales that actually come from the US, we can see that Nike, surprisingly, is the least exposed. 40% of sales for Nike come from the US versus 64% for On Running and about 66% for Hoka. So while Nike is going to suffer a big blow throughout this year, it actually might be even worse for its smaller competitors. The final thing that's going well for Nike is its balance sheet. The company carries a very minimal amount of debt, especially compared to net assets. This means that the company has flexibility if it wants to take on debt in order to make investments. It can buy back its own shares at a cheap price. It can keep paying the dividend, and actually, the dividend is well covered. The free cash flow is much higher than the dividend, so the odds of seeing the dividend being cut are quite low at the moment. As a matter of fact, Nike recently increased its dividend about a few weeks ago. So, all of that brings us to the very important question, which is how much is Nike's stock really worth? What's the fair value for Nike? Currently, the stock trades at a $57 per share and an $84 billion valuation. I like to use the total shareholder return calculator on Rated A. And for this one, we're actually going to be working backwards to get a market return of 9% per year. What needs to happen? Dividend needs to grow at 5% and 100% of it needs to be reinvested. We need to expect a terminal multiple of 18 times free cash flow, which for Nike is not unheard of. This is actually pretty conservative. We can assume a tiny amount of share buybacks. We can assume a drop in the free cash flow margin to 7%. Currently, it's around 12 to 13%. Most importantly, we can expect that for the next 5 years, the company will actually lose revenue at about 2% per year. What's more likely to happen is the revenue will drop off at a faster rate for the first 2-3 years and then rebound after that. But for an average, let's take a 2% decline per year for the next 5 years. In order to get the market return on that, we need to buy Nike at $40 per share. So for Nike to be a fair value, we need the stock to be at $40 per share. That does not include the margin of safety. Ideally, when you make a purchase into a dividend paying stock, you want the total shareholder return to be much higher than the market return. Personally, I'd like to go for 13, 14, even 15% per year, so that even if the company does not perform as expected, my return will still be decent. So in order for me to even start considering Nike, the market cap is going to have to drop to around $60 billion. That's around a 27% drop from the current stock price. And while that might sound like a lot, keep in mind that in the last year, Nike is already down 36%. This year alone, the stock is down 22% in 4 months. So it can definitely happen. If it doesn't happen, it's not the end of the world. What's more important for us as value investors, as dividend investors, as long-term investors is to avoid the risks, to avoid the big drawdowns. That comes from picking high-quality stocks and at fair valuations. Currently, Nike might be considered a high-quality company. It's currently rated as a B on Rated A. That being said, the valuation is still too high, in my opinion. A very important lesson that can be learned from this case study is that data and numbers can be very deceiving. Right now, Nike has a super high value rating. It's clearly a buy signal because optically the company is cheap. The free cash flow multiple is very low. But like you just saw in this video, all it takes is a little bit of digging to see that the free cash flow level is likely to come down for this company. So data can be deceiving, numbers can be deceiving. It's important to focus on the story and the narrative of the company. At the end of the day, what matters most for shareholder returns is what's going to happen in the future, not what happened in the past. And data looks at the past. That's it for this video. Leave a like and subscribe to the channel if you like this type of content, and I'll see you in the next one.